And thank you to the NAPF for the invite to come here and talk today. So I'm going to cover three things today. First of all, just a bit of context on how we decide how much we're going to charge and the way in which we split the charge out between schemes. Secondly, on the consultation exercise that we've just finished, we published our policy statement last week, as Frank said. So I'll cover that in the second stage, and then I'll talk about the next steps, including our current consultation on the final levy rules, which is running until the middle of November, and the things that you as trustees or advisors can be doing to make sure that the levy you're charged is an appropriate one. So I think in terms of context, it's perhaps helpful to start in terms of a snapshot by looking at our most recent annual report and accounts. The PPF has grown a long way since it was set up in 2005. We've around about 200,000 members now. In terms of our assets, we have around 16 billion of assets actually that we hold ourselves, and there are a further 5 billion of assets which are in pension schemes that are in an assessment period that we expect to come into the PPF. By comparison, we're looking at around about 19 billion in liabilities, again split between ourselves and those schemes in assessment, which means that overall we've got a funding level of around 112%. That's clearly a good place to be, but we're not complacent because we recognise that we've got quite a long way to go before we get to the point where we can consider our long-term funding position to be fully sound. And I'll talk a little bit more about that funding strategy in a moment. Just to talk about those assets, this is a breakdown of the assets that are already with the Pension Protection Fund, and you'll see that just under half of them are actually from the schemes that have gone through an assessment period and come into the PPF. In fact, if you add the 7% that are recoveries from insolvent employers, then it's just over half. We've also made a return on our investments in terms of our assets of around 18% of our assets come from investment returns. And finally, the levy is contributing just under a third of the assets that we have to date. So around £5 billion of levy has been collected over the last 8 years. So I said I'd talk about the funding strategy. So we updated this alongside our annual report and accounts, which we published in July. Now, our funding strategy was first published in 2010. We haven't actually changed our objectives since then, which is to be self-sufficient by 2030. It was actually interesting to hear Jonathan talking about his, in the previous session, the scheme that he was involved with has actually got a very similar target. Now, in order to assess that, as I say, we look at essentially a range of outputs from a stochastic model, the long-term risk model. You can see a chart on the right which does that, and that really looks at how our asset and liability positions might develop over the next 15 or 20 years. And you know, by that time, we could be looking at a situation where, rather than the 20 billion of assets and liabilities that we have in ballpark terms now, we could perhaps be looking at 40, 60, even 80 billion of assets and liabilities. So that says that we're really quite at an early stage in our journey in terms of reaching that target to be self-sufficient by 2030. And by that time, we'd be aiming to be fully hedged, to have a 10% reserve for the claims that may occur after that 2030 point, because we recognise that by then we'll have a large, we'll have a high level of assets and liabilities that are already on our books, and so our ability to cover a deficit or sort of deal with a large future claim might be quite limited. So overall, we look at this and we say we assess it as a probability of success, and at the moment we think our probability of achieving this objective of being self-sufficient by 2030 is around about 90%. So that's good, but clearly we do have a remaining risk. Indeed, we think there's a 1 in 10 chance that we'll experience a 4 billion or more deficit at some point before 2030. So a significant level of risk remains. In terms of what the pension protection levy is, first of all, it's an annual charge on all eligible schemes. We publish our rules before the start of the levy year. If there are changes from the previous levy year, and generally there are at least some, then we publish a consultation with a draft of those rules looking for comments. And that's the consultation that is actually running right now and runs until the 13th of November. Now, back in 2012-13, we announced that we wanted to try and keep our rules stable for a multi-year period, and that was designed to give schemes more certainty about the level of levies going forward. So we set those rules for the period from 12-13 to 14-15. Our next 3-year triennium starts in 2015-16, and so that's the point at which it makes sense to look at change such as reviewing who our insolvency risk services provider is, and we've brought on board Experian for that purpose. And that's really the main change that's happening over the next 3 years. The other thing to say is that before the start of the levy year, we publish our levy estimate. That's the amount that we expect to collect in the following year. Now, it is genuinely an estimate. All of the data that's used in invoices has yet to be collected. So you'll be submitting that information in the run-up to March next year. So very much an estimate rather than a certain figure. But we published last week that we're aiming to collect 635 million, which is a reduction on last year's levy estimate. Two parts to the levy estimate. Two parts to the levy. First of all, a risk-based component. It's by far the greater share of the levy, currently around 90% of the levy. We're predicting that'll go up to 95, even 98% over the next 3 years. And that's charged based on the funding position scheme and on the insolvency risk of the sponsoring employers. And then a scheme-based levy, which is based on the, simply on the liabilities of the pension scheme. I've done a quick example of this risk-based levy calculation. So you'll see it is basically a multiplication of the underfunding risk in cash terms, the insolvency risk, multiplied by a scaling factor, which for the next 3 years we are proposing is 0.65. So all bills get scaled down by a third. And that calculates your risk-based levy. So I've done a couple of quick examples. Looking at a scheme with a 15 million deficit. This is a scheme which has an insolvency risk as low as it can be, so it's 0.2017. It's in the lowest risk band. So it's paying around £16,500 of levy, or roughly £1 for every £1,000 of underfunding risk. By comparison, a scheme which is towards the bottom end of the scale, levy band 9, is paying around about 10 times as much. And in fact, the overall range from top to bottom is just over 20 times. And the reason that I chose these numbers, that it is in fact an actual scheme which has a guarantor in band 1, and the scheme and the employer is in band 9, which I think brings out why the PPF has been quite interested to make sure that the contingent assets that it recognises really are representing a guarantor that can stand in for the employer in the event of an employer insolvency. In terms of how much we charge, as I said, we've just announced that we'll be aiming to collect £635 million next year. That's 10% lower than the amount that we aimed to collect for 2014-15. And it's what one might term a neutral estimate, in the sense that the board didn't actively choose to increase the amount or decrease the amount it collected. It simply allowed the changes in risk that have taken place since we last set the levy estimate to flow through. and that's resulted in this figure of 635 million. So I thought I'd have a quick question break at this point, if there are any questions. Otherwise, we can move on to the second stage.
And if you do have a question, could you please indicate sort of who you are and which organisation you represent? Thank you. A question here.
Isomakmi from Croydon. I'm from local authority. We have problem with these academies that have been outsourced and have been forced to join back into the in-house. They come with deficit. Are we not being penalized for work which are not supposed, which is due to political changes?
I'm sorry.
I'm saying that about these academies, colleges who have been brought back into the pension funds. They come with deficit, which has been accumulated for so many years. But if they've been brought in-house, we take on the liabilities.
Yeah.
And if we have those liabilities, it has an implication on our funding level. And when we come to the levy, are we not being penalized for the work that we're not liable for?
So if it's a local government pension scheme, then it's not eligible to pay the levy because it's not eligible to come into the PPF. Clearly, if an organisation is outsourced, then potentially that organisation, if it has a pension scheme, then that pension scheme would be eligible for the PPF, and so it will pay a levy.
Any other questions at this juncture? Seeing no hands, Chris, let's move on to the second section. Thank you.
So, the second section, I was going to talk through our proposition for our second levy triennium and the move to Experian. So, first of all to say, we appointed Experian just over a year ago, in July 2013. It was the result of a competitive tendering exercise, and we assessed at that time Experian's off-the-shelf product, Commercial Delphi, against the other bidders. Since then, Experian offered us the opportunity to develop a PPF-specific model. We've worked with them on that over the last year. We assessed that based on success criteria that we agreed with the industry steering group that we set up. NAPF were represented on that steering group, CBI, TUC, the actuarial profession and ATCA, a number of other people that we thought would be able to help us with our thinking. And they developed these success criteria. We assessed it. We found that the PPF-specific model was a significantly better predictor of insolvency. And so that's the significant reason why we decided that we wanted to use this PPF-specific model. As I say, it's more predictive essentially because it's targeting the sort of employers that sponsor defined benefit pension schemes. They're much larger, they're much more long established, they're actually predominantly in different sectors of the economy than the average UK business. So the average UK business is 5 or 6 years old, it employs 1 to 5 people. By comparison, the sponsors of defined benefit pension schemes number their employees in the hundreds typically, their assets and liabilities in the millions. So very much a different universe of employers to the typical business that the D&B or Commercial Delphi model is trained upon. So much more predictive, more robust as well, and less easy to manipulate because it's predominantly looking at financial accounts data, and that obviously is harder to manipulate than non-financial measures such as number of directors or similar. It's also, I think, a more customer-focused model because we can offer a web-based solution to allow stakeholders to actually look at the score that they've got and the data on which that score is based. And we started with offering that to schemes and advisors. During the summer, we rolled that out as well to the employers. In addition to the web portal, there's also a free email alert system and an opportunity to use a what-if tool, which actually you can download and you can see what a particular change in the financial position of the employer would do for the score and therefore potentially for your levy going forwards. It's also more transparent because we can publish the full recipe for the PPF specific model. Indeed, we did in our consultation exercise. And it's more tailored in that we have 8 different scorecards that can subdivide down our 17,000 employers into more homogeneous groups. So I've just put together the 8 scorecards here. They're divided into scorecards which are targeted towards group members or alternatively standalone businesses. They're also divided between those that submit full accounts and those that submit smaller companies' accounts to Companies House. Full accounting data, without doubt, allows a better judgment of the risk of an employer. But if we've only got small accounts information, it's much better to use that in a specific scorecard rather than try and put it through the same scorecard as the full accounts information. We've also got a separate scorecard for not-for-profit organisations, and that reflects the fact that our standard scorecards didn't score those organisations well. They've got different characteristics, but when we look at our specific not-for-profit scorecard, it scores in terms of its predictiveness at a similar level in terms of the way that we assess these things, the Gini coefficient, as the other scorecards. I'm just going to talk through one of those scorecards a little bit. I'm not going to go through all of them. We'd be here half the afternoon. But the large and complex scorecard at the top there, it's based on 7 variables. 6 of them are drawn from financial accounts, both from the profit and loss side and from the balance sheet side of the financial accounts. In addition, there is a 7th variable, which is mortgage age, which reflects the age of the most recent secured charge against the business, if one exists. So that's the sort of number of different variables that you'll see on each of the scorecards, around 5 to 7, and very much focused on financial information. So, have we got any more questions at this stage?
Chris, could I throw one to you? In moving to Experian, there are clearly some winners and losers. Then hopefully be a period of stability as you sort of work with Experian. So two elements to the question. One is, in the consultation, you considered whether or not to have transition relief. You finally decided against that, so maybe you can just sort of comment on that. And secondly, what stability do you think will now come with Experian, and to what extent will they refresh and refine the model as they go forward?
Yes, of course. So, I mean, first of all, I was going to cover the transitional protection material a bit later, but okay, I can pick that up now. Essentially, that was something that we put in place as an option. We asked for opinions about whether it was a worthwhile thing to do or not. And I think there's a trade-off. Essentially, transitional protection would have meant that those with very large increases, because their Experian score is much worse than their D&B failure score was, would have seen the maximum increase in levy reduced. The problem is that has to be paid for somewhere, and so that would have increased the costs for the bulk of other schemes, albeit by a relatively small amount. But the message that we got, whilst I think there was some support for transitional protection, particularly I know the NAPF were keen on the idea, and there was some other support from other stakeholders. However, overall, there were actually rather more of our responses that were arguing that it probably was a continuation of essentially a cross-subsidy that should be finished as soon as possible. So I think that was really the sort of the challenge that we had, was that sort of, you know, division of opinion between different stakeholders. And I think lacking a consensus that it was the right thing to do to have a level of cross-subsidy through the transitional protection, then it was difficult for us to do something on that. In terms of the stability going forwards that Frank asks about, I think our ambition is to keep our rules pretty much stable over a 3-year period. Because the Experian model is new, we will clearly need to keep it under review during those 3 years, and if there is something significant that we need to address, then we might address it sooner than that, the end of that 3-year period. But our general approach is to try and keep things stable where we can.
Thank you. Any other questions before we move on to the final section? Yep, one here on the right.
Thanks. Paul Glenn from Aon Hewitt. I think the question goes back to actually the previous section you had, but also your comment about keeping things stable. You've got a sort of long-term secure target in mind, and you've described that you've got a 90% chance of achieving that, although there's some risk on the downside. Presumably that also means there's some substantial risk on the upside, and there's quite a high chance that you'll find yourself ahead of plan at some stage. When that happens, do you envisage a situation where you start to give some relief to schemes by saying, you know what, we don't need to collect levies for a year or 2 or 3 if you experience that, or is that not something we should be holding out for?
Well, it's a bit tricky actually. The current legislative framework doesn't make that sort of thing easy. One of the restrictions on us is that each year we have to publish that levy estimate, and we're only allowed to have a levy estimate for the following year that's 25% higher than the levy estimate for this year. So technically, if we ever were to have a levy holiday, we couldn't actually ever introduce a risk-based levy again. And so we've spotted that one. And also, our scheme-based levy can only be 20% of the total levy, so we couldn't have one of those again either. So I think if we get to that point where we're getting closer to 2030 and there is a risk of a surplus, a significant surplus in excess of the 10% that we're aiming for arising, I think that's the point at which we might need to have a conversation with government about an appropriate change to those sorts of rules, and possibly, for example, also, I don't know, this is just speculation, but maybe looking at some form of being able to make repayments. You know, it's a long way off, but I can see that there is, at some point there might need to be, a change to the legislative framework in which we operate.
And you indicated that for the next levy, you have adopted a neutral approach when setting the scaling factor. Or that's what the proposal is?
Yes.
Yeah. Right. I think we've got about 10 minutes left, so we'll move on to the final section.
Okay, so this is really just to talk through the highlights from our recent consultation. First of all, we covered all of our plans to introduce the PPF-specific model. And as I say, we published a draft of the rules that would be used to calculate levies in that circumstance at that time. We also mentioned the idea of potentially using credit ratings where they're available instead of the score from the model. That wasn't terribly strongly supported by stakeholders, so that's not something we've proceeded with. Similarly, we've talked already about transitional protection, and we explored that again as an option. Outside of the sort of model development, we also talked about some other policy issues, in particular the treatment of asset-backed structures, where we said 2 things really. First of all, we expected that if they're to be taken account of in the levy, we would want to take that account of them based on what value the trustees would be likely to get in an insolvency situation from that ABC. And secondly, at the time we were suggesting that the kind of ABCs that we would recognise would be limited to those that were underpinned by UK property. Now we've changed our view on that, and I'll touch on that in a moment. We also covered issues around contingent assets. We wanted to put in place what we call a realisable recovery. That's essentially an amount that the trustees will certify as a fixed sum that they're confident that the guarantor is actually able to pay in relation to the guarantee. We also said that we wanted to adjust the score that Experian calculate for the guarantors to take account of the scale of the commitment that the guarantor's making and what impact that might have on its balance sheet if the claim were to come to fruition. And again, we've made some changes in terms of what we're doing on that. So, consultation responses we received in the period up to July, which we just reported on. First of all, it's the highest rate of response that we've had to a consultation. So 122 responses, highest rate since we originally set up the risk-based levy in 2005-06. Those consultation responses, a lot of them were about the detail of the model. Now, first of all, we did get a lot of support for the principle of a specific model for the PPF. I think a lot of our stakeholders get the idea that it really is chalk and cheese when you're looking at the typical DB sponsor and the average UK business. I think there's a lot of support for the idea that assessment of risk should be based very heavily on financial information. So the key issues that were raised with us on the model were, if you like, at that second level of detail. So they were about the appropriateness of particular variables for some sectors or for some individual employers. There were issues raised about the possibility of arbitrage, people moving artificially between different scorecards. So, for example, choosing to consolidate their accounts in order to move onto the large and complex scorecard. We also, as I say, had limited support for use of credit ratings and for transitional protection. And on the non-model issues, we got a lot of feedback around ABCs and some concerns about that suggestion that we would limit them to UK property. We also got a fair number of responses on contingent assets, and in particular around that suggestion that we would adjust guarantors' scores. And there was a concern that in some cases, not all, but in some cases that there might be an element of double counting, because if you look at an ultimate parent company that actually already has the deficit of the pension scheme on its balance sheet, then it seems a bit like double counting if you then also adjust its insolvency risk to reflect the size of the guarantee as well. So I think the conclusions we came to, we've changed our policy in a number of areas in response to those consultation responses. So first of all, we have announced that we are going to continue with our PPF-specific model. We are going to use the scores that are generated by that from the end of October. However, we've made changes, first of all, in terms of the design of the variables that are used. So particularly the issue that was most raised with us was the measurement of secured charges. We're making changes there. This issue of potential sort of artificial movements between scorecards. We've changed the entry rules for the large and complex scorecard so that simply consolidating the accounts of a group company doesn't automatically place you on that scorecard. We've also understood from a number of stakeholders that whilst they might file smaller companies' accounts at Companies House, they actually have full accounts and they'd like to be able to provide them to Experian. So we've changed the rules that we set up initially so that they can do that. In terms of asset-backed contributions, that suggestion that we would restrict recognition of ABCs to those that were underpinned by UK property, we've ditched that. Instead, what we're saying is that the valuation approach that is used must be consistent with a basis that we set out in our ABC's appendix, which we've published in draft form. And we say that the valuer who's giving that valuation will need to owe a duty of care to the PPF, or rather to recognise that the report is being used for the purposes of calculating a levy. And that will, we hope, concentrate minds and lead to a more consistent valuation between different valuers, and to help to ensure that we get appropriate recognition of these structures, which clearly can have great value to schemes. On contingent assets, we have implemented our proposals in relation to realisable recovery, but again, we've listened on that point about double counting in relation to the adjustment of guarantor scores. So we'll only do it where it's not an ultimate parent, so it's unlikely that the deficit's reflected in full on the balance sheet of the guarantor. I'll just touch a bit more on the secured charges, because actually that's the change that we've made that's going to affect most schemes, I believe. So first of all, why haven't we ditched this this particular component of the scorecards? The first thing to say is it is a powerfully predictive indicator. So Experian tell us that, broadly speaking, a business that has a secured charge is about 3 times as likely to go insolvent as one that doesn't, and that more recent secured charges lead to a higher risk, and older secured charges to a lower risk. So overall, we think it's right to include it in the scorecard as designed. However, we recognise that there are a number of issues. First of all, data isn't available all around the world on whether there's a secured charge against the assets of company. So where it's not available, we'll be giving a neutral score, effectively taking it out for those countries where we can't obtain the data. Where we can obtain the data, we're proposing to exclude a number of particular kinds of charge from the calculation. So first of all, pointed out to us, charges in favour of the pension scheme. Well, that doesn't appear likely to be linked to increased insolvency risk, so we recognise that. Rental deposit charges raised by quite a few stakeholders. We've looked at that. We've looked at the data, and as far as Experian can tell, again, not linked to increased risk of insolvency, and also not actually being recorded after this year by, they're not registrable at Companies House anymore. So we're going to take those out as well. Finally, remortgagings. The point that was made to us was if you have a 5-year-old secured charge and you replace it with a new one on better terms, surely that makes you a lower risk, whereas a crude measure of how old your most recent charge is would suggest that you're actually a worse risk. So what we're saying is that where there is a refinancing on similar terms, that it will be possible for the officers of the company to actually provide a certification that allows that, that charge to be ignored. Finally, we're also consulting in our consultation on our detailed rules that's going on at the moment on the charges that could be excluded as being immaterial. We've suggested some measures for that, but we're interested to hear what stakeholders think. And in some of the cases I've set out above, particularly rental deposit charges, possibly charges in favour of the pension scheme, we think that Experian will be able to identify a good proportion of those charges proactively. However, where they don't, or for those situations such as a refinancing or rollover on similar terms, or a charge that you believe is immaterial, then that will need to be certified. We've published draft examples of the forms that we would suggest that we're planning to use for that purpose. So those will need to be certified after the rules have been finalised in December. So just in terms of timescales going forwards, we're now out to consultation on the draft levy rules. The web portal that Experian operate for us has been relaunched. It's got updated data on it. It was relaunched to coincide with our consultation last week, so it's worth going back onto that and looking at that again. Scores are used from the end of October. we close our consultation on the draft levy rules halfway through November. We will publish, and this will be a race, but we will publish before Christmas our final rules for 15-16, at which point you can certify those mortgages. You can, by that point as well, exchange ought to be online, so you can provide information on scheme and employer data that will be used in next year's levy. And the deadline for that, of course, is the end of March, and invoicing will begin in September 2015. So things that I'd emphasise for schemes to think about. First of all, the web portal refreshed last week. Do go on and check that your data and your scorecard is correct. Scores may have changed for a number of reasons. So first of all, I've mentioned a number of policy changes. But secondly, Experian are actually capturing data from a wider range of sources than they previously were. And that reflects the feedback that we've had from stakeholders about additional source locations where we could pick up data. So, for example, collecting data from the PRA, from HEFKey, and from others. And so that may affect the score that you have. Experian have also improved their identification of foreign ultimate parent companies. So where in the past, potentially, an employer was being scored with the top of the UK tree being assessed as the ultimate parent, if there's an ultimate parent in France or Germany or the United States, then increasingly that is being picked up, and therefore that may change the score as well. And actually these other factors are probably going to change as many or more scores than the policy changes that I talked through with you. So from December, you could start to certify any mortgages that you need to, and by March, data needs to be submitted on exchange or where relevant to the PPF. So any further questions?
At the front here.
I wonder what your attitude will be like to errors on invoices from the PPF. So you've been quite strong on not accepting issues.
Errors that we make,
yeah,
because we do make errors sometimes.
You do make errors, and
we
if
will
more,
correct
we
errors
have
that
to
we
pay.
make.
But what about if a company identifies an error that will you actually look at it, or will you just say no, I'm ignoring it?
Yeah, I'll answer that. But I will answer the question that you didn't ask first. Where we make errors, or where Experian make errors on our behalf, we will, we will correct them. So
Chris, just to interrupt, before you answer that, given the time, can we just sort of check if there are any other questions? We're slightly over time, so we'll just check if there's any other questions, then bring it to a conclusion. I think there's one in the middle there, and I've had one through on my iPad. So,
two there.
So if we take all the questions, then we'll try and wrap them all up, Chris. Thank you.
Okay, it's Fiona Chen from RPMI, and we are the administrator of a railway pension scheme. My question is specific to the mortgage age, which, because we have train operating companies, when the franchise change, they actually need to set up a new company, which then they secure a new mortgage, which seems unfair, for them being penalized for secure a new mortgage, but it's necessary for the procedure to secure the franchise change.
Okay, thank you. And one on the second row here. Thank you.
Hi, Sian Lee, Scottish Power. You mentioned that now the new method means that scores are less manipulable. So previously there was some flexibility and some actions that employers could take to take some control over the level of the levy. And now that the scorecards are based on data in the reports and accounts, does that mean that there is no flexibility, or are there still any measures that companies can take?
And one final one, second row, sort of four in. Thank you.
Grenville Johnson, Calmac Pension Fund, Scotland. I'm constantly having to be in touch with you and in contact with you to try and explain to you what a Scottish government-owned company is. And year after year after year, we seem to have to constantly retell the same tale. And this last year has been actually one of the worst we've ever had in terms of having to argue with you over the levy. And it's cost the scheme a heck of a lot of money. And that's cost our members a heck of a lot of money, on top, of course, of the levy, which I view as a tax on the scheme. Is there any way at all that your organisation can capture the actual true legal position of a Scottish government-run company and hold on to that information forever?
Chris, I wonder actually whether, in relation both to the Scottish question and Fiona's sort of fairly technical question about rail franchising, maybe we could take those after the session and just deal with the general ones. The general one that came in to me was that the scorecards are very much on sort of company attributes. Did you look at industry sectors as well?
Okay, I can pick those up. Yes, absolutely. So, I was just halfway through the answer to you on corrections. Where you've made a mistake, I think the answer is you should you can ask for a review of your levy, and you can set out the reasons why the error took place, and essentially we will consider the situation on a case-by-case basis, and it's by no means the case that we reject every application. If I can move on then to, is it being less manipulable means there's less that you can do? Well, I think that's true in terms of, you know, things like adjusting the number of directors, etc. However, I'd emphasise that that means that there should be perhaps more focus on tackling issues around funding. So, you know, sort of looking at ensuring that if there are deficit reduction payments, that they're certified. It may be that there's capacity to put in place a contingent asset, such as security over land and buildings or other assets. It may be that there's the possibility of a parental guarantee, and I think all of those options are open to schemes and employers to consider, and I think we'd encourage a focus on those rather than essentially trying to, necessarily always focus on improving the insolvency risk score, though I recognise it does have a very big impact. In terms of company attributes, I mean, that's right. We did look at, or we did consider whether there was a role for industry sector in our scorecards. And the problem there really is just that is twofold, really. First of all, although we were able to subdivide down our universe of 17,000 employers into 8 groups, we do need 3 or 4, around about 3,000 employers, and around about for each of the sort of last 7 years to have enough data to produce robust statistical results. So the problem with industry sector is that with the exception of the not-for-profit sector, if you think of that as an industry sector, I'm not sure it really is, but with that exception, we really didn't have any sector that was large enough to produce statistically robust results. There's a second problem with it. Industry sector was indeed a component of D&B failure scores, and we're aware that there was a sort of continuing trend to employers looking to get themselves reclassified by D&B into the industry sector that they would say most closely represented what they do, but perhaps that led to the best score as well. And so I think industry sector is a particularly gameable thing to look at. So that is a second problem there.
Fine. Thank you very much, Chris. I appreciate we have slightly overrun, and we're eating into your refreshment time. There's now a break until 4:20 when Joanne is running the next plenary session. Thank you all for your engagement, and in particular to thank Chris.
Thank you.